The US financial system, is it a fortress of stability built to withstand anything? Or is it more like a house of cards, just waiting for the next stiff breeze? To get to the truth, we're not going to rely on hot takes or scary headlines. No, we are going straight to the source, the Federal Reserve's own comprehensive health check, the November 2025 Financial Stability Report. We're going to dive deep into the official data to find out what it really means for the economy, for the markets, and most importantly, for your money. So, what is the real story here? I mean, on the surface, things look remarkably solid, remarkably resilient. But we all know that looks can be deceiving. Is the foundation truly strong? Or are there some serious cracks starting to form just beneath the surface, just out of sight? That is the fundamental question we are going to investigate together in this video. Now, before we get into the Fed's data, just one quick thing. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Your support really does make these deep dives possible. Okay, let's get into it. All right, here's our game plan. This is how we're going to break it all down. First up, we're going to look at the good news, the case for optimism, that resilient economy the Fed keeps talking about. Then we're going to put on our detective hats and start searching for the cracks beneath the surface, because they're always there somewhere. We'll uncover what the experts themselves are most worried about, get a crucial verdict from the all important bond market, and then see what the powers that be are doing to keep the whole system's plumbing from getting clogged. And finally, we'll tie it all together and figure out what it means for you and your financial bottom line. Okay, Section 1, a resilient economy. Let's start with the official story, the top line message coming straight from the Federal Reserve. And right now, that message is one of calm and stability. This is our baseline, you know? This is the good news that we have to understand before we can start looking for the hidden risks. Our entire analysis today, everything we're about to discuss, starts right here with the Fed's own financial stability report from November 2025. This isn't my opinion, it's not speculation. This is the actual data our central bank is looking at to make its decisions. So, what's the official story they're telling us about the health of the economy? Well, the positive news is pretty widespread. The Fed says the banking system is sound and resilient. They point to the fact that capital buffers are at historic highs, which is a direct lesson learned the hard way from the 2008 crisis. And get this, the total debt burden for both businesses and households, when you compare it to the size of our economy, is actually the lowest it's been in 20 years. For you and me, mortgage delinquencies are low, and that's because most of that debt is held by people with strong credit scores. So on paper, it looks like a very, very solid picture. And this chart right here, this is really the heart of that stability argument. Look at that top line. That's debt held by prime borrowers, people with good credit, and it's adjusted for inflation. It's been basically flat for more than a decade. You know that old story about the over-leveraged American consumer? Well, based on this data, it just doesn't seem to apply right now. By and large, household finances are in pretty good shape. Section 2, cracks beneath the surface. Okay, so if households are solid and the big banks are well capitalized, where is the risk hiding? Because let's be honest, risk never really disappears, does it? It just moves. It finds a new home. So let's start digging. This is where we start to see what I like to call a tale of two ledgers. On one side of the book, you have the American household, stable, strong equity, low delinquencies. But on the other side, a very different story is playing out inside our financial institutions. The Fed itself flags elevated asset values, high hedge fund leverage, and this one is really interesting. Leverage at life insurance companies is near an all-time high. You see, the risk hasn't vanished at all. It's just changed its address from Main Street to Wall Street. And this visual, wow, it just makes that shift absolutely undeniable. On the left, you've got that flat, stable line of household debt we just talked about. But on the right, that climbing line, that's leverage at life insurance companies, pushing up towards 25-year highs. It's about as clear a signal as you can get that risk has migrated from one part of the system to another. Let's just pause on this direct quote from the Fed for a second. In simple terms, what's leverage? It's using borrowed money to try and amplify your returns. So for life insurers, it means they're taking on more and more risk to try and meet the long-term promises they've made to their policyholders. Now, when times are good, this is great. It boosts profits. But if their investments go south, those losses are also magnified, which can create instability not just for that one company, but potentially for the millions of people who depend on their policies for their financial security. Section 3, a wall of worry. All right, now that we've seen where some of these internal hidden risks are building up, Let's zoom out a little bit because the financial system doesn't exist in a bubble. So, what are the big external threats? What are the things that are really keeping market participants, investors, and policymakers awake at night? To get a feel for this wall of worry, the Fed does something really smart. They go out and they ask financial experts a simple question: what's the single biggest risk out there right now? And the answers they got in the fall of 2025 were dramatically different from what they heard just 6 months earlier in the spring. The market spheres are shifting, and believe me, they are shifting fast. And the changes here are just huge. First, look at policy uncertainty. This reflects major worries about what the government is going to do next on spending, on taxes, on regulation. I mean, when businesses don't know the rules of the game, they just stop. They hesitate to invest, they hesitate to hire. Next, look at the absolute explosion in concern over higher long term rates. It jumped from just 9% of respondents to 43%. That is a massive fear that the era of cheap money is over for good, which of course impacts everything from your mortgage to the cost of corporate debt. And finally, geopolitical risks more than doubled, which just reflects a world that feels increasingly unstable and unpredictable. So, this chart gives us a really clear breakdown of those top concerns. Policy uncertainty is leading the pack at 61%, but right on its heels, you have geopolitical risks and then the twin fears of higher rates and persistent inflation, both tied at 43%. These four issues right here represent the dominant anxieties for anyone trying to manage capital in today's global economy. Section 4: The Bond Market's Verdict. Now, that huge jump in concern over higher interest rates, that brings us directly to the most important market in the entire world, the market for US government debt. This is not just another asset class. This is the bedrock. It's the foundation upon which the entire global financial system is built. So, what are US Treasuries? Really, it's simple. They are just loans to the US government. And because the government can always print money to pay its debts, they're considered the safest investment on planet Earth. You can think of the Treasury market as the financial system's heartbeat. The interest rate on a 10-year Treasury bond, that sets the rhythm for everything else: your mortgage, your car loan, the loans that businesses use to grow. If that heartbeat becomes unstable, the entire system gets sick, fast. And that right there leads us to the fundamental problem. The US government has a massive and growing national debt. To fund its day to day operations, it has to constantly issue new bonds and find buyers for them. But what happens when the supply of all that debt starts to overwhelm the demand from investors? What happens when there aren't enough buyers? This quote just nails it. If politicians won't get government spending under control, eventually the bond market will force their hand. There's this old concept called bond vigilantes. These are large investors who can basically protest irresponsible fiscal policy by just selling bonds or refusing to buy new ones. And that drives up interest rates for the government. They can force discipline where politics has failed. And this chart right here reveals some early warning signs of that kind of strain. It measures something called market depth. Think of it like the market's ability to absorb big trades without breaking a sweat. So if you want to sell your house and there are 100 interested buyers, that's a deep market. If there's only one buyer, that's a very thin market. Now, while the 10-year market has recovered a bit, you can see the 2-year market depth at the bottom is still way down, near historic lows. That thinness makes the market much more fragile, and that is a major, major concern for regulators. We're at a really crucial turning point in our analysis, so this feels like a good moment to just pause for a second. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, so we've identified this serious strain in the all-important Treasury market. So what, if anything, are the authorities actually doing about it? Section 5, keeping the system liquid. Well, seeing these signs of strain, the authorities are not just sitting back and watching. They are taking proactive, very technical, behind the scenes actions to make sure this critical market continues to function smoothly. So let's pull back the curtain on one of their key initiatives. The main tool they're using right now is something called the Treasury Buyback Program. The concept is pretty simple. The Treasury itself steps into the market and buys back its own older, less traded bonds. This helps keep the market running smoothly, and it also helps them manage the government's cash flow. But the Treasury is being very, very clear about one thing. This is just routine maintenance. It's like an oil change for the financial system's engine. It is not an emergency bailout tool for a crisis. And let me tell you, this program is operating at a serious scale. Between May of 2024 and January of 2025 alone, the Treasury bought back over $92 billion of its own debt. This is not some small experiment. It's a significant ongoing intervention designed to maintain the health of the system's absolute core. So, is it working? Well, the Treasury's own assessment says it is broadly achieving its stated objectives. For regular, plain vanilla bonds, the operations were very successful. The results were a little more mixed for the inflation protected securities, or TIPS. But overall, the program is functioning as it was designed, as a steady, predictable presence, helping to keep the gears of the massive bond market turning. Section 6, Your Financial Bottom Line. Okay, we've come a long way. We've looked at the high level data, the institutional risks, the government's response. Now, for the most important part of all, what does all of this mean for you? How does this connect to your money, your home, and your future? Let's start with the housing market, which for most families is their single biggest financial asset. And right now, its health is a perfect example of this delicate balancing act that's playing out across the entire economy. One of the direct results of all the risks we've been talking about is that banks are being cautious. They're nervous. This chart shows that lending standards for commercial real estate remain really restrictive. And that means credit isn't as easy to get, which acts as a brake on real estate transactions and price growth. Basically, the banks are playing defense. But that's only half the story. The other half, the much more positive half, is this. Very, very few homeowners are actually missing their mortgage payments. Delinquencies are extremely low. And why is that? Well, it goes right back to what we saw at the very beginning. Household finances are strong, and the lending standards after 2008 got much, much tougher. So while the market itself might be cooling off, the actual foundation of American homeownership looks pretty solid. All right, now let's circle back to life insurance. This connects directly to that institutional risk, that rising leverage that we identified earlier. This is an industry that millions of people rely on for their long term security, but the landscape is quietly becoming much more complex. And this chart shows you exactly what's changing. That growing area on the chart represents what the Fed calls non traditional liabilities. These are complex financial tools that insurers are using to try and boost their returns. You can just see how their reliance on these tools has surged over the past decade. This added complexity and the risk that comes with it is exactly why the Federal Reserve is keeping such a close eye on this industry's leverage. So, what's the big takeaway for your own investment portfolio? The message from all this analysis is pretty clear: play defense. First, focus on quality. We're talking about companies with rock solid finances. Second, try to avoid companies that are loaded up with tons of debt. They are the most vulnerable in a world of higher interest rates. It's also worth considering real assets, things like energy or commodities, which can act as a shield against inflation or a weakening dollar. The bottom line here is that this is not a market where a rising tide lifts all boats. Being selective is absolutely crucial. And that is our deep dive. As you think about how all of this applies to your own situation, just remember that navigating this kind of complex environment can be daunting. So, one last time, before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you are looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Thank you so much for watching. And that brings us to our final thought. We've seen a system that is, on the surface, pretty stable, but it has these risks shifting and growing just underneath. We've also seen that the authorities are now actively managing the very core of that system to prevent it from breaking. So this leads to one final provocative question. With all of this constant management and intervention, maybe the real risk we face isn't another sudden dramatic crash like 2008, but instead a slow, steady erosion of financial stability over time as debt grows and complexity just keeps increasing. Something to think about.